Harsh Roongta of apnapaisa.com is our expert for the day. But Harsh, the first rule of financial planning, everyone says, is fixing the goals. But what a lot of people don't take into account while fixing this goal is inflation. So when you actually calculate the returns, especially in life insurance or maybe in real estate, what's the best way to account for inflation? Because that is, suddenly turning out to be a key determinant with inflation trending at 10%.
So I think this issue of not taking inflation into account is something that affects both your goals and the way you calculate your returns. So I mean, people say normally plan for their child's education, and they say, let's assume your child is 4 years old, and if you was to go for an education course today, say it would cost 20 lakhs. Now since you need this money 14 years later, you can't just plan to accumulate 20 lakhs. Even assuming a 10% kind of an inflation in education costs, that cost is going to climb up close to about 76 odd lakhs. So you need to plan for 76 lakhs, otherwise you're going to not be able to fulfill that goal probably. So that is one big I think error that most people make.
But what is the thumb rule for accounting for inflation? Do you take today's inflation, annual inflation rate? How will you discount inflation?
So I think typically you have to take an estimate, and it could be different for different kinds of costs. So when I'm estimating education costs, it could probably be a little higher than the general inflation. Typically for our clients we like to take about 8%, but if you take specific costs like say medical costs or inflation or education costs, it could be around 10%. And so I think really estimating that, you could go a little wrong in the actual inflation, but the very fact of including inflation will make sure that you don't go hugely wrong.